Welcome to Illuminati Silver. We tell you the truth about silver. Today is Sunday the 8th of May 2016 and we are reporting on the World Silver Survey 2016 produced for the Silver Institute by the GFMS team at Thomson Reuters. The key facts are as follows. Mine production increased by 2% or 18 million ounces to 886.7 million ounces. Scrap supply fell 22 million ounces. Industrial fabrication demand fell 4% or 22.5 million ounces to 588.7 million ounces. Overall physical demand rose by 39 million ounces or by 3% to 1,170.5 million ounces. Demand for coins and bars rose by 24% to a total of 292.3 million ounces, mainly due to heavy buying from North America and India. Jewellery demand rose to a record high of 226.5 million ounces, up 2.5 million ounces on 2014. There was an annual physical deficit of 129.8 million ounces compared with a deficit of 78.6 million ounces the year before, and is the third consecutive year of deficits. Silver prices averaged $15.68 in 2015, down 17.8% compared to 2014. So what do these figures tell us? Well, firstly, we're not running out of silver. And all of these silver mines, which the scaremongers said were closing, and that silver would become scarce as supply would slump, has proven to be rubbish. Mine supply actually rose yet again for the 13th consecutive year, albeit at only 2%, compared with an average 4% in previous years. Secondly, as we predicted last year, industrial demand has fallen. In fact, instead of it representing 54% of total demand, it now represents just 50%. Thirdly, investor demand has increased, and silver bars and coin demand now represents a total of 25% of supply. It is important to note, though, that most of this demand came from India and North America. Interestingly, the weak scrap supply, which fell by 13% and represents a decline of 22 million ounces, which is approximately 43% of the increase in the overall physical deficit increase, has been blamed on low silver prices. With prices now rising, this may indeed change for 2016. So what do we make of all this? Well, without doubt, silver demand by investors has increased. Last year, the industrial demand fall helped to minimize price increases, and the fear of interest rate rises certainly kept silver prices down. We, believing that the Fed were hawkish and would adopt a typically monetarist approach to the economy, expected the rate rise in December, though we felt it should have risen earlier. We also expected 2 rises in 2016, though the dovish comments from Yellen may suggest that once again only 1 rise may be likely, and certainly not the 4 they originally proposed. From a fundamental point of view, with silver running at a deficit supply of 129.8 million ounces, with average prices standing at $15.68, we can see no reason why supply could not increase again should prices remain close to their current $17.50 to $18 level, as many of the major companies have all-in sustaining costs below these levels. Naturally, a different picture may ensue should prices fall back again. Which now brings us onto our view of how we see prices moving for the rest of this year. If this was a non-election year, we would, quite frankly, expect prices to move down quite considerably in the latter half, as it did in previous years. However, the US government wishes to stabilise markets before its presidential election in November, and frankly will provide dovish statements to ensure this is achieved. They are content for the dollar to fall a little, but not too much. So a dollar index moving between 90 to 97 is acceptable to the Fed. This will prove bullish for both gold and silver, especially if the majority of that time it moves between 90 to 94, as we suspect it will. We have seen in the early part of 2016 quite considerable buying of silver by China, and this can point to two possibilities. Either they anticipate increasing growth in their economy beyond the sub 7% GDP predicted, or, as we suspect, they believe their currency may indeed fall further, thereby stockpiling their needs now in anticipation of that fall, as prices will then become more expensive. We will, of course, monitor such purchases very closely over the coming months and assess the trend. We see for 2016 no fundamental demand reason for higher prices much beyond the $15 to $16 level. However, we fully accept that worldwide negative interest rates, the uncertainty over the US presidential election, the maintenance of a low US interest rate policy, will edge both investors and speculators into gold and silver, thereby maintaining a relatively high support level. How high can prices go is anyone's guess, as much of its movement will now be based on fear and currency jitters. We believe that $20 silver is unlikely, but possible, and if it is reached, it will be momentary, and it will eventually fall back to the $15 to $16 range. $13.50 gold again is possible with a 1400 ceiling, though again we envisage prices moving back towards the $11.50 to $12.50 level. We are now more neutral between gold and silver, especially as silver has now caused the GSR, or gold to silver ratio, to fall to levels around 73 to 1. We hope you have found this video interesting and informative, and if so, please give it a thumb up and share it on Twitter. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe as a free member for regular email updates and offers. Our Facebook page, which is updated daily, can be found at facebook.com/IlluminatiSilver. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal